What is up, everybody? I am Scott Melker, and this is the Wolf of All Streets podcast. Today's guest is a friend of mine, and I can't wait to dive deep into his business, which has been making headlines on Forbes, Business Insider, Yahoo Finance, and more. Upon discovering blockchain technology and already having an edge in app development and the mortgage industry, Curtis stopped everything he was doing to mix the three together and found B Mortgage App. Now I have the chance to better understand how Curtis Wood and B Mortgage App are disrupting $1 trillion and massively flawed industry with blockchain technology. Curtis, man, it's a pleasure to talk to you again. Thank you so much for taking the time.
I appreciate you having me.
So before we get into the questions, once again, you are listening to the Wolf of All Streets podcast, where twice a week I talk to your favorite personalities from the worlds of Bitcoin, finance, trading, art, music, sports, politics, basically anyone who has a good story to tell. This show is powered by Blockworks Group, a media company with over 20 podcasts in their network. You can check them out at blockworksgroup.io. And if you like this podcast, follow me on Twitter. You should definitely check out my website and join my newsletter where I share all my trades, charts, analysis, market thoughts, and lessons on improving your trading and investing. You can check those both out at thewolfofallstreets.io. And now to get onto it. So as I touched on, this is a massively flawed industry, the housing market in general and the mortgage industry. Can you tell us a bit about your current thoughts on the present market and the situation in the country right now?
My present thoughts on the country?
I won't go there. Your present thoughts on the housing market in this country. God, man, it's a hard time not to talk about the present situation in the country. But
it's a crap show. The housing market. The housing market's supposed to be $3.4 trillion this year. So we're hitting premium capacity in terms of loan, origination. There's a ton of refi with low rates. And this is coming from people who purchased maybe even 12 months ago. You're 12 months into a brand new home and rates drop and you're already, ready to refi. So it's kind of crazy. From the lenders I talked to personally, one of our investors is a senior VP with Wells Fargo. We have another partnership with Florida Capital Bank. Both of these, shops are doing almost 3 times the volume. And this is all during COVID. So it's honestly crazy what's going on. In addition to the market being $3.4 trillion, that's the end of year estimate right now. Young people, Generation Mobile, millennials, they're the largest home buying group this year. 1.2 trillion is the estimate. So my opinion, yeah, it's real big. Older millennials are already refinancing or moving on to their second home. And for the newer ones coming into the housing market, their parents remember rates, 10 to 15% when they bought their first house, in the 80s, and they're coming in and getting a 30-year fixed for like 2.75%.
Yeah, it's really crazy. I mean, when we were kids, yes, the rates were that high, but you could also put your money in a bank and get like 10% interest sitting in a savings account, which is a conversation for another day. But that's really interesting that millennials are buying homes. I can say that I'm not a millennial, but for one, that the minute that things went down with COVID, I refinanced, slightly higher than where the rates are. And I've only been in my house for 3 years, but it's like free money, right?
It's free money.
So you can't blame people. But doesn't that create yet a bit of, a lack of supply first, right? You have all these people trying to take money, but there's nothing to really buy.
Yeah, there's only so much mortgages in America. And whenever these rates drop, it somewhat has a ripple effect through the secondary market. But if rates are dropping and people are refinancing, then there's going to be a market there for it. And the mortgage market is a whole. It's cyclical. It goes through periods of, a ton of purchase volume, then a ton of refinance volume, as rates kind of fluctuate. But rates are projected to be this low for like the next 2 years. Which is crazy, because typically in the past, we would see rates drop for this low for a few months, and then they go right back up. But, the money machine in Washington, D.C. is printing and printing and printing. and they're going to keep the rates low to keep asset prices high, and it's going to benefit homeowners that are just now getting into the marketplace.
But interestingly, that's, the idea of money printing, people think of these huge printers literally printing money, but this is actually the way they print money, correct? They make money available for loaning, and then the banks go loan, and there has to be a demand for loans from the public.
Yeah. Yeah. And when the demand goes down, we'll see rates, start to go back up. The lenders are loving it. We've bootstrapped for almost 2 years. We had a successful pre-seed raise, so we didn't bootstrap, once we got that capital infusion. But I talk to people right now, loan officers, that they're doing like 50 and 60 grand a month in commission. And it's rarely been that way for a sustained period of time. It would get that way for maybe 3 to 4 months, and then rates would go back up. But right now, just people are killing it.
And it's the Wild West. I mean, it's the Wild West. When I was doing mine and Given, it was like, I jumped in right when it hit, you know what I mean? And I saw it sub 3%, and it was crazy, but they couldn't even lock me in any day. They would call me, and if I didn't get back to them in 20 minutes, the rates had changed, and they had to go back to the lender to figure out if there was even a deal. And they weren't even answering people's calls anymore. There was so much demand. I've never remember it being like that, even in the previous crash. And
so when rates move that quickly, that's it. Like you said, it's uncharted territory. It's kind of the wild west. We used to have rate changes once a day, and just every once in a while you'd get a midday change, like maybe when Brexit happened, there was a major shift, just something big. But like you said, now lenders you can see rate fluctuate 3-4 times a day.
It's crazy.
Like you said, not lock you in just because rates are going to change.
Yeah, it was nuts. Fun, but nuts. So talk about your background a little bit. What got you interested in doing this? And then we'll get more specifically into how you're disrupting the industry.
Yeah, so I went to work for PHH Mortgage, which did white label originations at the time. They got acquired by Ocwen, but at the time, we did white label originations for Merrill Lynch, Morgan Stanley, Goldman Sachs, just all of the prestigious, names on Wall Street, KeyBank, Apple Bank, PHH would originate for. So I say that because at PHH, they had super strict and compliant internal controls because they had to manage these contracts, with Merrill and Goldman. So, my first job into the mortgage industry, they taught us how to take a clean and compliant 1003, which is the loan application. And that's the foundation for all kind of mortgage success after that. And being in the leadership position I'm in now, where I'm looking at the big picture, the number one cause of file defects, cures, buybacks for a lender come from errors that humans make in the 1003. And, there's been a lot of technology that supposedly has come in to fix that, but still human error is the number one cause of risk for lenders. So PHH was my first job. Before that, I was at iMobile 3. They did white label mobile app development. They built Moe's Southwest Grill, Great American Cookie, the Contractor app with Home Depot. And so I did that, and then I got into mortgages, and I was on the front lines, just writing loans, and I enjoyed it. I really did. I'm a mortgage guy at heart, and I'm not a banking guy, and I'm not a guy who has letters after my name, in terms of an MBA and all these, degrees.
Me either.
Super intelligent guys. So I got the skill of being able to explain how a mortgage works in non-banking language. So, I call him my one superhero is that I'm in mortgage lending, but I can explain the way the mortgage process works to somebody who isn't. My two 14-year-olds, for example, if I can make them understand how a mortgage works, we're pretty confident that the process that, is simplified enough or whatever. So went to PHH. They were, B of A did not renew the origination contract with PHH. They had previously purchased Countrywide, so they took some of their loan origination in-house at B of A and Merrill. So we all saw the writing on the wall. And from PHH, I went over to EverBank. And this was right before they got acquired by TIAA. So it was at EverBank where, again, I was a loan officer on the front lines and just dealt with all the pain points. I did a loan for a woman who used to sit on the board of the Federal Reserve. Wow. And TIAA is a huge financial institution for academics, teachers and all that. And I'm sure you know the background of them. But she gets denied. And this was not an agency loan, so it wasn't going to Fannie Mae or Freddie Mac. But she gets denied because an interpretation of her assets was deemed as being non-liquid. And she wanted to waive escrows. She wanted to pay them on her own. So we had to establish some liquid assets for her. Big house, big money. So I have to relay the news to her that she is denied. And she was not happy. First she cried, and then she got mad, and then she called the CEO of EverBank. And about 2 hours later, I got an email saying that her file was approved.
Hey, it's how you get it done.
Yeah.
For her.
Yeah.
Yeah, but that seems like such a common problem, right? I mean, I can tell you from my own personal experience, I was DJing. I didn't have a W-2. I was an independent contractor. My money was paid in 1099s from all over the country. My income never counted towards anything. I could never get a loan for decades.
Yeah.
No matter how much money I made, it was almost irrelevant. Or it was that and the combination that it was paid to a business account and not to my personal account. And that didn't count towards collateral.
Then you got to produce K1s and So
nightmare.
Yeah. As much as we're doing with automation and, some other of my competitors in the space are doing with automation, nobody has cracked the self-employed borrower nut yet. And there's a company called SoftWorks, and they have an AI platform that we're actually going to be leveraging unless my MIT developers come up with something better. But it can do everything except read a purchase agreement and like 1040s and K1s. They can't get the technology to do that. That's and whoever does at some point is going to come up with a very successful software program.
That makes sense. And then good luck convincing them that crypto is an asset that should be counted as part of your income or your holdings, because I tried that recently and got literally laughed out.
Yeah. You can convert it and then we'll count it, but no.
All right. So let's get into what you guys are specifically doing, because obviously anyone who's applied for a loan of any sort, much less a mortgage, has probably had a frustrating experience up until this point, right? So you guys are solving quite a bit of that.
Yeah, and it's still frustrating. We're solving as much as we can, but nobody's going to be able to solve the whole thing. First of all, we can't touch a self-employed borrower. We're only touching the W-2 borrower. Now, thankfully for us as a whole, typically a loan officer's pipeline will have anywhere from 70 to 80% of a W-2 borrower. So a majority of the pipeline is what we're trying to automate, which is good. Our belief being if we can automate 70%, we're going to be able to triple the loan officer's production on the other stuff that requires his attention, like K1s, 1040s, 2 years, tax returns, that sort of thing. So that's the idea, behind us being able to get our acquisition costs down to where we're projecting it'll get down to. But when I was at EverBank, I did, just dealt with everybody who had a complaint. I was the guy they talked to as a loan officer. You deal with the good and the bad. And probably 2 or 3 times a week, somebody would ask me, I'd like to apply for a mortgage, whether it be a purchase or a refinance, but I don't want to do it with you. Do you have an app or do you have a website I can go to? And back then, they do have a website. You can apply online now, but back then they didn't. I mean, this is a Fortune 100 company. So, that's kind of what sparked the idea of a mortgage app. People are asking me for it. Robinhood's around, just there's apps everywhere. So Rocket Mortgage came out around this time. Everybody in the lending industry kind of held their breath to see if it was going to be a real mobile mortgage, how much would it handle. And it didn't turn out to be a mobile mortgage. It's only a mobile loan application. You apply in Rocket Mortgage, and then after that, you've got to talk to a loan officer. You get to go through the same old crappy process.
So it basically eliminates the front end friction, but once you've filled out your application, you're back into the same old system.
It's a lead generation app for Rocket.
Yeah,
and
lead gen.
And it's slick. I mean, they've got the capital and the ad campaign to roll it out. Because if you ask anybody, when I go pitch B to an investor, the first question they ask me is, how is this different than Rocket Mortgage? Because they think Rocket Mortgage is a mobile app, and I've got to explain to them that it's not, But I'm on the front lines of EverBank. I get asked if we have a mobile app. Rocket comes out. It's not a mobile mortgage app. And then Bitcoin hits 20 grand. I think this is December of 17.
Yeah.
Okay. So everybody's talking blockchain. It's a big buzzword. So I do some research, and I come across a paper by PricewaterhouseCoopers, and it talks about the benefits of blockchain for the mortgage industry. And being on the front lines and experiencing all the pain points, they nailed it. I mean, that was my light bulb moment. They nailed it. And what it is, I'm not a software engineer, but I understand that it is a trusted validation protocol. So you take, for example, when I take a loan application for W-2, forget self-employed borrower. When I take a loan application, I'm going to verify electronically your credit, your income, and your assets. These are pulled from the source. We verify them directly from your bank account. Okay.
Is that through an API? Does it pull through it? Yeah.
Yeah. Right in Encompass and the loan origination software. I'm just, hitting an access button. API pulls the data in. So I get 3 credit scores for you. We have to use your median credit score. I get your assets from your checking or your savings account. Say it's a total $100,000. And then I get your W-2 income, which is verified through Work Number, through Equifax. It's a service through Equifax. And I get your income 150 grand. Those are the 3 qualifiers for credit approval. Okay? Until you have a home under contract, I can't do anything else with you. All I have to do is verify your credit, your income, and your assets. Now, those data points, I also must accept as is. So in other words, if your credit is 619, I can't go talk to my boss and say, can we get an exception for this? Because Fannie Mae will only take files that are 620 or higher.
Right.
Okay? So every time I'm doing this as a loan officer, and it's repetitive and it's mundane, and I have no idea why I'm doing this, that specific function of validating data that has to be accepted as is, the lender cannot change it, that can be done through a smart contract. And there's no reason why it shouldn't, because it doesn't require me to, from a human analytical standpoint, do anything. It's just a yes or a no. You either have enough assets to meet the LTV, you either make enough money to pass DTI, and your credit is either high enough or it's not. And then I would clear the milestone. I'd wait for you to get the contract in, get a home under contract, and then I'm doing more work. So that was my light bulb moment there, is that we could automate that credit approval process right up front. And that's what we're building.
And anyone who's been through that knows how frustrating it is to gather all of that paperwork, and then you go back and forth. And oh my God, when we were doing that refinance, they needed a new bank statement literally every day because of what I was describing, how much it was changing and fast. You'd be like, but how much money do you have today that you didn't have? It's insane. So providing all that documentation has to be a huge point of friction for getting people approved. So what happens? Right, you go into the app. You basically originate your loan, right? Say how much you want, go through this process of getting all these documents verified, then what happens?
So the reason we don't have a mobile mortgage is because the technology has not been built for a consumer to interface with their phone the entire time through the entire mortgage process. Instead, it is relying, loan origination software is built for a loan officer to sit at the controls with a mouse and a keyboard and a setup and manage all the data. Okay. So again, what we're doing is we're simply automating the credit approval process, but there is a ton of engineering behind that to make that automation possible. So number one is we're building an entire mortgage experience in a mobile app, from the question and answers, which simply model the same questions you would get with a loan officer. Some of these other products like Blend, Mortgage Hippo, some of these other point of sales, banks have a fault and they want to just dump information on the borrower. They want to just give you the form, the 1003. Now they give it to you in a digital format, but and you're looking at it and you see all the fields that you have to complete, and it's overwhelming. The easiest part of calling Wells Fargo is whenever I'm talking to you as a loan officer, I'm just going to ask you some simple questions. And they're just yes or no. You got a job. You have 2 years tax returns. Do you have a home under contract? You're looking for a single family home? Are you looking for a 30-year fix? And, similar to TurboTax, where it has a very simple, easy to use interface, you just sit there and answer some questions, and then TurboTax logic and software kind of populates into the form fields. So that's what we're building. Number one is the actual mortgage experience, all of it, not just applying, but even after you apply, inputting, uploading the purchase agreement, selecting the closing date, your earnest money deposit, just all of that stuff. And we're starting with a complete mobile mortgage experience. And then our guys who are much smarter than I'll ever be are figuring out the automation steps and how to hook it up.
It's so interesting. So how many people are going to be out of work when you guys take over the world? Listen, that's the nature of technology, right? All of these things are meant to save time and money, which effectively eventually eliminates jobs.
Tech is a double-edged sword. It is. And for home buyers, it'll make home ownership more affordable. For loan officers and processors, we're thinking that one loan officer will be able to triple their loan production. So instead
this is busy work. This is busy work. You're eliminating the busy work. And as much as you may eliminate some loan officers, the ones who are there are going to be pretty psyched not to have this headache, right?
Yeah.
It's the worst part of the process.
Yeah. Most of your pipeline are people with good credit, income, and assets. They're great. This is everyday people. They pay their bills on time. Their hard work, all of that good stuff. You rarely talk to those people. They sail right through because there's no issues. Okay. That's what we're trying to automate is the people who, number one, they don't want to talk to anybody. They don't want to deal with a loan officer. They want a mobile experience. But number two, automation can help them because as a loan officer, I don't have to touch them. They qualify. They sail right through. Now, again, we're talking about all this good stuff we can't do, or we can do. Let me tell you what we can't do.
I was literally going to ask, is there a point where I go on my phone and 3 hours later I have a mortgage?
Well, so Figure has a fantastic HELOC, and they're absolutely going to lead the market with that HELOC. And they're using blockchain. I don't know sure the exact application, but they can get you a HELOC in three or 4 days.
For anyone listening, that's a home equity line of credit. If you're not in on the lingo, I know that because I also did that recently. So
that's Mike Cagney's company, and And I don't know exactly how they're using blockchain. I think they're using it more to process the data on the back end and maybe for the investors. But to answer your question, can you get a mortgage in like 3 to 4 days? No, but you can get a HELOC and you can get it through them. The reason you wouldn't be able to get a mortgage in 3 to 4 days is because of Dodd-Frank. Now, I can verify your income. I can make sure you're qualified using Fannie Mae Day One Certainty in 15 minutes. Fannie Mae will accept that credit, that income, that asset verification. But I've got to send you out a loan estimate in 3 days. Then I've got to wait another, I think, 14 days. Then I've got to send you another initial closing disclosure. And then I've got to wait 3 more days. So,
still sounds like a much less of a headache than most people have with the process. So obviously all the law would have to change for it to be able to do that. And you're basically ready to innovate as the law allows.
Yeah. And there's a big push to rescind a lot of Dodd-Frank. And I am a huge free markets guy, but I remember what the industry was like when subprime origination was at 20 and 25%. And how you had all these ninja loans and everybody was lying. There was fraud everywhere, and of course nobody could qualify for them because they didn't think they were going to have to pay for it in 6 months. They were going to flip it for a profit. Everything was going up, so everybody was fine. What Dodd-Frank did, and it did a lot of good, it did a lot of bad for the customer experience, but the primary benefit it brought to the marketplace was it reduced subprime origination to almost nothing. Now, that's not to say fraud is eliminated. There is fraud, I'm sure, somewhere. Somebody's cutting a corner to make a buck. That's going to happen. But Dodd-Frank stiffened the penalties for mortgage fraud, 30 years in prison, $1 million fine. They instituted stricter licensing procedures. Oh, my goodness. Getting a mortgage license is a huge pain. I'm lucky I passed all mine. Serious. I barely made it out of middle school. And I studied my butt off, and I got lucky. I passed them all. There was 3 people in our PHH class of like 30 loan officers. These are smart guys. And I'm not kidding. I'm a C- student. And there was only 3 people in that class that passed all their exams. They're incredibly difficult. But the other thing it did was that it flooded the mortgage process with paperwork. And just for example, like we used to send out a GFE, a good faith estimate at the beginning. Well, they replaced that with what's called a loan estimate. It's basically the same information formatted differently. And it is a good document. It's easy to read. I like it. But the problem happens is that whenever a mortgage file is going through mortgage processing, the numbers change just frequently. Dodd-Frank mandates that almost every time your mortgage numbers change, I have to send you a new loan estimate.
Start again, yeah.
So you get like 3 or 4 throughout the process. You don't even have to sign them. You don't have to view. You have to view the first one, but the rest of them you don't have to view. But they all say, please sign, date, and return. So it's absolutely confusing. So one of the benefits that a mobile app gives us is that we'll still be able to disclose documents to you, but I'm not going to send you an alert unless it's a document that you have to view and sign. So you'll get a little alert, and the rest of the documents will be in your B Mortgage app, but you're not going to know they're there. You're only going to get that little, red number 1 next to the ones that you do.
That makes a lot of sense. So Dodd-Frank was the response to the 2007-2008 subprime mortgage crisis. Can you talk about, you just said, and this I think touched on something probably so interesting. You remember the Wild West. You remember when it was absolutely insane in those years. What were people doing? Where was the fraud? How did this bubble happen?
So,
we've all seen The Big Short, and we know that like strippers in Miami were buying 7 houses with cash, and getting loans with no, we've seen the movie, but.
First of all, I want to be very clear. I was not in the mortgage industry back then, but one of my best friends was, and he worked at AmeriQuest. I'm not going to say his name. So what happened is a phenomena of fraud. just there was fraud everywhere. It was greed. That's it.
Mm-hmm.
And the overwhelming belief that housing prices will never fall. They always go up. Historically, they've never fallen.
Okay, so, it was actually true until then, but
it was true until then. Yeah. So what you would have, and this is in maybe like 2002, you started to see a big growth in subprime origination. So you would go in to like AmeriQuest, who's out of business now, Countrywide, who's practically, they're gone, B of A absorbed them. You tell them you want to buy a house. First of all, internally, there was no loan origination system that as a requirement to produce a 3.2 file for Fannie Mae, there wasn't an actual asset or income or credit verification module that was there. Now there is. I can't get around it. That tri-merge credit pull goes straight into Encompass, and that credit score populates. So it is what it is. Back then, they were taking, like if I pulled your credit and it's 480, they would have another credit report right here on their desk. I would put Scott Melker's name on it and your address and your social and just upload it into the loan origination software.
God, I've worked so hard to have good credit. I could have just stolen the document.
The craziest thing at AmeriQuest, they had an appraisal software that would print an appraisal at whatever value you wanted it to be at.
RoundlyX.com is one of my favorite companies in the entire crypto space. What they do is take all your small purchases and round them up to the nearest dollar and invest that spare change into any of over 30 crypto assets of your choice. They integrate with your favorite exchanges so that you can view various exchange balances all in one dashboard and round up into different assets all at the same time. And they do all this without ever holding any of your Bitcoin. This is by far the best way to dollar cost average into Bitcoin. Go to RoundlyX.com and use the promo code WOLF for $4 in free Bitcoin after making your first roundup or purchase. That's ROUNDLYX.com and code WOLF for $4 in free Bitcoin. Diginex is making huge moves and is soon to be the first crypto exchange listed on the NASDAQ. This means that people will finally be able to invest on a platform they're comfortable with without being directly exposed to Bitcoin. Absolutely massive for mainstream adoption. Diginex has basically everything investors need under a single roof, including an institutional-grade exchange called EQUOS. EQUOS allows institutional and retail investors alike access to an exchange that's on par with platforms they've come to trust in other markets. This means they are compliant with regulation, transparent and fair with regards to fees and orders, secure and far ahead of the curve in regards to innovation. Go to equus.com/wolf to get 5% off trading fees. That's EQUOS.com/WOLF to get 5% off of your trading fees. Sign up now. Unless you've been living under a rock, you've heard about the DeFi craze in crypto. By far the safest and simplest way to passively earn in the space is to hold your coins on Celsius. You can earn your rewards in the same crypto you're holding, or you can earn even more in their Cell token. Right now, I choose to earn 5% on Ethereum in Ethereum and 15% on my stable coins in Cell token. It's a little bit better than the sub 1% interest rates you can earn in a legacy bank account. Celsius was founded with the belief that crypto is the opportunity to really shake up the financial system. They're changing the standards for all financial services. They share 80% of their revenue in the form of weekly reward payments. That's how their users are earning up to 15% APY with compounding rewards. They also commit to providing the lowest cost loans on the market. Their loans start at just 1% APR. For just 1% interest, you can borrow cash against your crypto and avoid selling, which also eliminates the taxable event. It's absolutely huge. High rewards on your holdings and low interest on loans on a platform whose mission you can believe in. Celsius is giving $20 to every new user that joins with promo code WOLF. Just enter the code in the app during registration. $20 is awarded after 30 days of maintaining a wallet balance of $200 or more. Visit Celsius.network, that's CELSIUS.network, and use promo code WOLF, WOLF. Appraisal is such another Wild West ridiculous industry. And I've been through like having an appraisal that was 20% difference within a month, going for a loan. So, I'm sure. So basically it was like, this wasn't just like people taking advantage of a system. It was outright fraud. Like
It was
fully
outright-
just upload a fake document, get the person approved, get them however much money they need. But then what? So you give that bad mortgage, that subprime mortgage, but the real collapse comes when they start packaging, repackaging, reselling, third time, fourth time, fifth time, right?
Yeah, and I don't want to put this all on the bank because there was fraud at every level of the mortgage chain. Because number one, let's say that I, as a customer, I go in and I apply for a loan. Okay, I don't know where to lie. I don't know where to cheat. Okay, so if I don't make enough money, the loan officer says, "Hey, I can't qualify you for this loan with Fannie Mae, but there's another one over here where you get to state your income and your assets."
So they tell you to lie. They tell you to lie.
No,
Right.
you have to agree to it, and it's your fault if you lie. But I mean, the fraud was everywhere, and it was driven by greed.
And the trusted person that is telling you the person you trust, who you went to, just says, write this number on the line. You're not thinking that you've just committed like fraud that's going to put you in jail.
Oh, no, they never disclosed it to you like that, But yeah, that's exactly what it was. And so you had Wall Street, the greed on Wall Street. They just wanted to eat these loans up because they were making a ton of money. And this is, if you've ever seen, The Big Short, I know you've seen that. Margin Call. Margin Call is another really good movie. You had all these adjustable rates, and there was the initial period where they don't adjust, and they would put you in an arm because the loan officer makes more money, selling it as opposed to a 30-year fixed. A balloon payment, points. There was something else Dodd-Frank got rid of. If I'm a loan officer, I used to be able to get a commission based on how many points I charged you. That's no more.
Not allowed to force that. Yeah.
Yeah. So, you got all of these crap loans, adjustable rate mortgages with unverified income and assets and straight up fraudulent appraisals, home values, and credit reports that they, like you said, they started packaging up. They couldn't sell them by themselves. So they started packaging up. They take them over to Moody's, and the woman's got the glasses on, like she's had her eyes dilated. She can't see anything, and she's stamping approved in AAA. And eventually what happened is just like that guy caught, when these rates start to adjust, people aren't going to be able to pay their mortgages. And they didn't anticipate they'd have to because they were planning on flipping them in 6 months because values are just straight up.
Works till it doesn't, and then the house of cards falls. But why is Wall Street interested in buying a package of crap loans?
They didn't know they were crap.
I mean,
there were very few analysts who picked
or did they just think they could flip them next? Well, yeah, I mean, you saw it. I mean, to reference The Big Short, it was like he was the only guy who noticed.
Yeah, I think there was 3 or 4 people in the world who realized what was going on. Certainly Greenspan didn't. He's on Capitol Hill talking about how the housing market's
greatest market,
ever. That's a complete side story, but they didn't know they were crap. They didn't. I mean, they were buying them, and if first of all, you've got like the brokers, you have laymen. They're buying them in bulk. They're keeping them on their books for like 60 to 90 days while they layer them up, package them up, and then sell them. It was like getting caught with a hot potato.
I mean,
when the music stops.
Literally flipping it. It's like chopping up a car and selling the parts and then selling those parts. I mean,
And there's one thing though. People say nobody went to jail. No banking executives went to jail, but there are some guys in California, mortgage guys, who went to prison for fraud.
Yeah. A couple guys. Probably not the guys that everybody wanted to see. I'm sure they were criminals. Don't get me wrong. Listen, all these people were perpetuating known fraud. They should all be in jail. But never seems to, the punishment never seems to fall at the top of the food chain, I guess, needless to say.
Angelo Mizzo, the first Orange Man. You remember him? He had a real bad tan. Okay. He skated away with a couple $100 million from the countrywide sale to B of A.
Yeah, take your small fine and keep your bounty. It's
Slap on the wrist.
It's pretty crazy. So now we have. It's funny, when COVID hit, I assumed we were going to see a housing crash.
Me too.
Right? I mean, it seemed common sense that like nobody's moving, nobody's going to buy anything, the economy's crashing, people are broke. Like a $1,200 stimulus check isn't enough to get you through buying a house, right?
For 9 months.
What the hell, man? House prices are higher than ever. I mean, I was dead wrong. Obviously, it may come to be, but what the hell?
So there's two factors: low inventory, and there's a lot of buying demand
because of the loans.
Yeah,
because it's so cheap.
That's helping refinance demand, and the investor doesn't care. I mean, if it's a refinance or a purchase, they care about the loan terms and the credit, all that. But they don't care if somebody bought a year ago and just refinanced. They'll buy that new loan. So inventory, I personally think, and there's no evidence for this, but we had a ton of inventory back from like 04 to 07. Tons.
Mm-hmm.
I think builders learned their lesson because inventory, they have been able to keep inventory extremely low. And you have this new home buying demand, which is coming in the marketplace.
So does that mean that they're just like not building 100 model homes and hoping they get filled? They're building on demand, or they're one parade of homes house for the season, and that's it. They're not throwing out a couple $1 million in houses assuming that there's going to be a buyer.
They learned their lesson. Yeah. They really did. So, I mean, in terms of COVID having an impact on prices and everything, I thought we were going to have a major crash. Some of my partners thought it was going to be worse than 08.
I did.
Like it would put 08 to shame, And a lot of people I know, from an investment standpoint, they were increasing their cash position. They're waiting on the sidelines, waiting to pounce, And we did. I mean, it did drop down, but
most people didn't buy it there.
There was, there was nothing in terms of a housing crisis like we saw in 08. And in their own defense, HUD came out with some very good programs, forbearance programs. Now the question is that what happens
when they expire? Those are going to expire.
I don't know what happens when they expire.
I mean, all the rent, that's all expiring, right? People are going to start being evicted and mass. See, that's all the stuff that I thought would happen, and they helped, but eventually they're going to stop helping.
I think if we continue, my personal belief, if the economy, and we're in Florida, so it's a different world than some other places under COVID.
Different world than every place all the time, but yeah.
You got that right. Cynthia and I, you get on CNN or Fox, it doesn't matter. And there's always that random story about Florida.
Oh, God, it hurts every time. I don't know if you know this, as a total aside. The reason that is, and I actually talked to Catherine Coley about this on my first podcast ever, Florida has very loose, they divulge all freedom of press, they divulge everything, like arrest records, all those things immediately, which most states don't do. So in Florida, any reporter or any person, the public, can see every arrest in real time and what had happened. So all this crazy stuff is happening in every other state. It's just public knowledge here. Yeah. Freedom of information. My brain was the Freedom of Information Act here allows for anyone to access those records, which are private in other places.
I didn't know that.
Yeah, nobody knows it. And we come off as jackasses, but it's actually a very progressive, and if you're into, freedom of speech and freedom of information, Florida is actually very far ahead, but it gives us this terrible stigma because everybody sees every ridiculous thing that happens in real time.
The only thing I hope for whenever I see one of those crazy articles, like man gets caught having sex with an alligator or something.
Yeah, in a swamp and 3 minivans and right.
I'm opening it up and I'm like, please God, don't let it be Jacksonville.
Every so usually they're getting them further south these days, it seems like.
Yeah.
So.
It's South Florida or somewhere over in the Panhandle where like there's a bunch of
we're in a bubble of where it's not too bad, hopefully. But it's crazy. So I'm sorry to interrupt there.
No worries.
Yeah. So, but we didn't see that crash like we were talking about before. But there has been the forbearance. But do you still think that that's potentially on the horizon, or do you think that we're kind of smooth sailing now?
I think there's a possibility for it. Going through that and then COVID, a global pandemic, you never say never again, and
about anything.
I actually insert, call me crazy, but we just went through 2020. And so I inserted a disclosure in our current fundraising round talking about any threat, including alien.
Force majeure, man, active God.
We launch our pre-seed round and a global pandemic hits. I can't sit down. I'm kind of scared to launch this next round.
The aliens. So what was it like? What was it like trying to launch a business?
Oh, man,
when that happened? I mean, we were in touch. So
talk
about bad timing and bad luck. I mean, it's worked out for you, but at the time it was a pretty rocky road.
Yeah. So we bootstrapped for a while. We joined a lot of VCs, alternate or alt portfolios, which is basically everybody they said no to. I think it was 15, 16. The crazy thing is I actually, a lot of these VCs would engage just random out of the blue. I'd send them over our deck. We were very, very early on the concept phase, and Cynthia and I, we didn't have the capital to pour hundreds of thousands of dollars into, development. So that was totally out of the picture. So anyways, we heard a lot of no's. We heard a yes from Fundopolis, which is a crowdfunding portal. It was a new portal, so they were pretty much taking on anybody. Hey, you're going to dance with the partner you're fine. So we launched it right before Christmas of last year, and we hit like 10,000. And it's the Christmas season. We're waiting on Christmas to be over and the New Year. And then we hear this thing about a Chinese virus. And that's how it was referenced just early on. There was a virus over there.
Something was happening in China.
Yeah. So Cynthia and I actually flew in March. And the week that we got back, everything shut down. But we had just picked up, I think we broke 100,000 in March. Mm-hmm. And we were just getting some momentum. And then the world shut down. So we kind of hustled through it, it did what we could. I still met with some younger investors who just flat out said, I don't care. I'm not quarantining. And so I met with some of them. I did Zoom calls with some older guys. But very early on, we realized we weren't going to hit our max goal, which was 500,000.
Well, people were terrified to spend money then. Everybody thought that they were going to be completely broke, right? That everything was going to collapse and it was over. So it's like discretionary spending sort of.
Yeah, and there was, if you looked in the marketplace, there was other much lower risk, investment opportunities on sale. So I'm out here. Oh yeah, I think it hit 3,000-4,000.
Bitcoin was on sale.
Yeah. My favorite quote is from Mark Yusko. He said, "Stocks are the only thing that when they go on sale, everybody runs out of the store."
Yep, it's so true.
Same thing with crypto and everything. They've called the death of Bitcoin I don't know how many times now, and it just
seems to be alive.
I loved your interview with Mark, or the
Yusko. Michael Saylor.
Mike, yeah, sorry.
Yeah. I had Mark Yusko, who you just mentioned, and that was like my other favorite interview probably of all time. So,
Mike Saylor, he said something that resonated with me. He said, "This is how I can do good." is basically buying Bitcoin. We have meager resources compared to the guy who owns 9,000 Bitcoin, or whatever he said.
Yeah.
But Brock Pierce said, the greatest disruption is going to come from people that disrupt themselves. And that was me as a mortgage guy. There's no doubt that the mortgage industry is in bad need of automation. The reason it's not automated is because lenders don't trust a computer program to do a human's job. But blockchain's different. You can trust that validation protocol,
But you also flat out said that the reason these things get messed up is human error. Yeah. So that's a misconception, right? Even like people, you trust your guy, but your guy is much more likely to make a mistake than.
Well, it's not just your loan officer. I mean, the processor touches the file, the closing coordinator, the underwriter,
too many people.
Yeah, there really is too many people, but that's the way it is. You not only have Dodd-Frank, but there's, Florida laws that we have to abide by. There's county laws. So, and I mean, title fraud is a big one. Just somebody inserting their own, wiring instructions into the process, and they get a phishing email. One of our investors and advisors, a guy named Andy Zinkel, he knows you and.
Yeah, in New York.
Yeah.
Andy used to we used to do DJ and club stuff together. That's amazing. Yeah. Awesome.
So Andy has been one of our earliest cheerleaders.
I think I knew that. Yeah.
For the longest time, but he stopped. And in fact, there was a Forbes article about it, or a Wall Street Journal article. He stopped like a title fraud, and he does big commercial title work.
Right.
And his instinct stopped like a huge fraudulent transaction. So the human element, again, it's everywhere, and it does create the greatest amount of risk for lenders. But what we're trying to automate it doesn't even require any human oversight. These are the mundane tasks, and all that stuff. We got off subject. Sorry.
No, it's awesome. Are there any other areas of this process that you think theoretically, I mean, maybe if some regulation changes or some rules where blockchain could really, really make a difference? Yeah.
So right now we have a title agent who will initiate a wire, and this is funding. I mean,
right.
And this is the girl or the guy at their computer. They put the wiring instructions in there and send it off. As soon as Duval County tax collector and the state of Florida agree to be paid in either a Fed crypto dollar
or digital dollar
or Bitcoin, a smart contract.
Why not a stable coin even, right? Because then there's no volatility, right? Yep.
But a smart contract could facilitate closing instead of a human actually initiating the wire and all that. So you could have an auto executing, and this is a ways off. Dodd-Frank is going to have to agree to it. I mean, this is a long ways off. The county, whoever is accepting the money, is going to have to agree to accept it in a different denomination than, a dollar or maybe a dollar, like you said. But we're going to see a lot of advances towards it. And there's a big push within the industry right now to scale back Dodd-Frank. And I don't know if I agree with that, but that's what the banks are pushing for.
Yeah, I guess what you just described is the most obvious application. Like, actually use a better currency that transacts faster and requires less human intervention. I mean, that is the use case for cryptocurrency, right? I mean, at its core, forget blockchain, but that's why we're here.
Yeah. Absolutely.
So, and then you would eliminate the fraud and also just the chances of one of those people in the middle making some sort of epic error. I mean, how stressful is it sending a wire? So much worse than just sending USDC to someone.
And I mean, if that wire goes to the wrong place and it's big enough, if you're the title guy, it can put you under. Your insurance, and it can put you under. So there's absolutely a use case for a smart contract in that regard. And it could plug into Proppy, what Proppy's doing, but Proppy's more on the registry side. A title agent, their entire function is to clear title and then facilitate closing.
Right.
and then they can plug that information into property if the county's using property, is a blockchain register or something like that.
It's just funny that we need an escrow agent. We still need a trusted party to hold the funds and make sure that they're distributed. And that's something we don't need a person for.
Yeah. Yeah. Clearing title is still requires a human element involved. And for the same reason, I mean, if you're the title guy and for however it happens, a faulty title, it's got a lien on it or whatever, if it ends up in the transaction, you're liable for that. You hope the homeowner has, title insurance. Always get title insurance if anybody is out there listening and thinking about buying a house. But
what a crazy world. So now you've been a couple of years deep in this, right? You've obviously found this great application for blockchain that's going to reduce a ton of friction. So I would imagine that in your travels and your thinking and brainstorming, you've come up with some other awesome ideas for where blockchain can be used, right? Like once you have that light bulb moment, I would feel like you would see all these applications. Are there other areas? I don't want you to give away anything proprietary or let anybody steal your idea. But like now that you're thinking about it, where else can blockchain really disrupt or help?
Well, as soon as I read that Price Waterhouse article, I realized I, as a loan officer, am not needed. I'm just not needed. Anybody can create an automation architecture, just structure. Okay. But the problem is that there was no trusted validation protocol for the data to go from this point to that point. We can move data pretty easily, but do we trust that it's the right data? So that you stick a smart contract in there and yes, we can trust it. So if I'm not needed as a loan officer, then that's the technology to power a mobile mortgage. Because again, if you think about Rocket, you apply on Rocket Mortgage and then you talk to a loan officer. You talk to a processor. So more of those mundane, repetitive tasks, to answer your question, where is it going? Do we have more ideas? It's simply to transfer more of the repetitive tasks that, number one, don't require a human element. Like there's no gray area. It's either a 1 or a 0. I can't change the data. And there's many points in the origination process that we could take that and put that into a smart contract instead of having, a manual decisioning and dependency and, which really just tie everything up. The more we can do that, the more of that type of automation, the lower my cost is going to come down to originate a loan. I get to pass that savings along to everybody else in the form of lower rates, which are ridiculously low to begin with. But, that's the type of automation that is really going to improve the customer experience because, and it's not just young people. If you've bought a house before, you know what to expect. Like if I'm going, most of my investors, these are older guys. They're like, yeah, I would like to do it all on my phone, but right now I've got to call my bank. Yeah, I already know what I want. Like if I'm selling my house and moving, I know I want a 30-year fixed. I know what price range it's in. Let me just plug all that in and go.
That makes sense. So what do you make of crypto loans? The Celsius and Voyager and BlockFi of the world, all these places that are originating loans with your collateral in crypto, no margin, no leverage, no risk. Obviously, they're loaning it for leverage at the end of the day. But
I think it's great. I really do. I mean, if you have been smart enough to acquire enough crypto, and I'm going to talk about it from a lending standpoint, a homeowner lender standpoint. If you've been smart enough, over the years to acquire crypto, you want to go buy a house, take out a loan against it, just knock yourself out.
Right. So then you skip this whole process. You just, you get your loan, you get your cash, and you...
if you're buying it outright. But if
you have to be buying with cash. Yeah, of course.
Correct. Yeah. If you're borrowing against your crypto assets for a down payment, and then you're going, to get a home loan, it's the same process.
You're toast. Yeah, you would have to be taking the loan, the entire loan, not just for the down payment. That makes sense. Yeah. I think that's going to be a huge disruptor to all of these industries to some degree. Not necessarily mortgages, but people who need personal loans or, for different reasons, kind of like a HELOC or something. So interesting, because then, I mean, there's just really no risk to the lender, right? They've got your collateral sitting in their own platform.
Yeah. Yeah. The young generation mobile home buying market this year is about 1.25 trillion. That's, what millennials make up of the overall market. And that's an average, but that's going to grow. The BlockFi and all those guys, that's a great business model.
They're crashing. Yeah.
I don't necessarily, there's enough market out there because not everybody owns crypto. Most people are still going to be getting a traditional 30-year fixed home loan.
Of course. I don't think it's going to disrupt this market anytime soon, but in general, for people who need smaller loans, it's nice to not, just have it quick and without really as much of a centralized.
What's Celsius paying right now?
Oh, it depends. Yeah. They're anywhere. I mean, depending on what your collateral, but like if it's a stable coin, almost 10%. And he explained that, it seemed, and then people think it's a scam or highway robbery or something. And it's just that they're actually giving you the money they're making instead of keeping it for themselves like a bank.
Yeah.
Literally, it's just doing what a bank does and actually sharing the money.
Yeah. I'm surprised BlockFi or even Celsius hadn't gone through, being acquired by Goldman or somebody else.
And now that we see like the OCC sort of giving the green light for banks to custody crypto, I think that that's somewhat of an inevitability. But maybe they won't sell it to someone who won't pass that on to the customer. Maybe, I've talked to Zach from BlockFi and Alex, both the CEOs of BlockFi and Celsius, and Steve Ehrlich from Voyager. They also offer a really high interest. And they all seem to actually be in it for the in it because it's important and they really believe in the cause and not because they want to sell it to Goldman, who will then keep the entire 17% and pass nothing on to you.
Yeah. If Goldman got involved, that would drop pretty dramatically.
They all seem pretty passionate about kind of F the banks, short the bankers, long Bitcoin, as Pomp likes to say, right?
Yeah. Yeah. I'm in a tough spot because number one, I'm a mortgage guy. That's just my background. It's what I enjoy. But I can't really integrate crypto into a loan that Fannie Mae is going to buy.
No way. Right.
And I'm a big crypto fan. We pretty much sold all our crypto, launch and B and through that bootstrapping process. But I would love for them to allow Bitcoin as an asset verification in the process.
Please. Oh, so good.
It'd be super easy to confirm. Okay. But it's only something that HUD has
it's easier to confirm than money, right? I mean, it's literally on a blockchain.
Yeah. Oh yeah. You have to go through more steps for me to verify a checking and a savings account through account check with form free than you do verifying your crypto holdings.
Here's my wallet.
Yeah. Oh yeah. So if HUD is to open up some of the restrictions on crypto, that's going to benefit B Mortgage app because we're ready to integrate as much as possible. But when I started out, I don't know if you remember the company Block 66.
I don't.
They were a blockchain mortgage company. So when I had my light bulb moment, I started to do some research, and there were some blockchain mortgage companies back then, and they're out of business now because they were trying to originate a blockchain mortgage, which number one, Fannie Mae won't buy. It's not compliant with Dodd-Frank. And the technology, they couldn't license it out to any lenders because it wasn't compliant with Dodd-Frank. So very quickly, I realized that, the wrong question is how do we originate a blockchain mortgage? The right question is how do we originate a qualified mortgage that Fannie Mae will buy using blockchain? And that implementation of it, just using blockchain, just starting out to verify credit, income, and assets, and then integrating more of the manual tasks into it as we go, is the right approach. Because at the end of the day, Fannie Mae doesn't know if a loan officer verified credit, income, or assets, or if a human did, because they're only looking at the credit score. They're only looking at the assets that were verified. And if a smart contract verifies it, great. They don't care. They never even see that part. But another reason some of these crypto projects failed was and you often see this in early adopters, which is the reason why we had an internet bubble. We had a crypto bubble and a crypto, company bubble, and it popped. And the companies that are around now are the ones that are truly building meaningful value and adding value to the space. But they looked at blockchain and they were light years ahead of anything that was applicable to the current market. And there were many companies like that. Nobody would adopt them. With adoption in the crypto space and even in the blockchain space, it's happening. But for the average person, they're not going to know it. This is smart. This is why Figure doesn't even market that they use blockchain for a HELOC. They market a 3-day HELOC. Great. People know how that works. They don't care about the technology.
That makes perfect sense. But so basically, they were way too far ahead of their time because they had an idea, but they didn't understand, like you do from being on the front lines, the framework that the idea would have to exist with it. You can't make the laws change. You can't get around Dodd-Frank just because you think you have a superior technology. You have to operate with what's there. Yeah,
and it is superior, but nobody can use it.
Right. It's superior, but you're going to go to jail if you try to bypass the mortgage system. So I know we're up against it here with time. So where can we follow you guys? What do you guys have coming in the future? You're still raising money, right? Where can people participate?
Yeah, we just launched our seed round. Our target is $1 million. We're offering a safe on WeFunder, and it's wefunder.com/bmortgageapp. And there's a lot of info there. In terms of a raised video info about the team. We just brought on some guys out of MIT. One of them's a genuine rocket scientist. These guys are super smart. They're actually in charge of building out our automation. We've got the customer experience down. We think the time with just all of the new young home buyers, who love mobile apps, we think the time is right for a genuine mobile mortgage experience. Think Robinhood app for mortgages, with AI and blockchain. So we've created the customer experience, and these guys are going to build out the automation framework. But other than that, we're going to be piloting our 3-minute pre-approvals for W-2 borrower. No self-employed borrowers.
No.
Yeah, but that's our next delivery. Our next milestone is to go through this seed round and then start showcasing our automation. And hopefully we'll go through a big Series A and, keep having success. But I want to thank you. You've been a huge supporter of ours for the longest time,
awesome.
fellow Floridian. We connected a while back. You're the only Twitter handle that I follow for Bitcoin news. And
that's awesome. And you get some Gator hot takes too, right?
Heck yeah, go Gators.
We're both Gator fans, guys. That's how we really met and became friends. We have to be honest. We didn't care about blockchain. We just want our team to win. Awesome. So where can everybody follow you personally?
I am on Twitter.
You don't have to remember.
I don't know my Twitter handle. I think it's bmortgagecw.
That's right. I think that's right.
Yeah, bmortgagecw.
Yeah. All right, everybody, I'll follow now. Well, thank you, man, so much for taking the time. I'm really excited about what you guys are doing, and I've seen it come a very long way. So it's exciting to see it coming to fruition for you. Now we just got to get you up to Washington to start changing the laws so you can even do more.
Yeah. Well, I forgot this. The app is live right now. Yeah, it's the mortgage calculator. Yeah, so go check it out. Just search B Mortgage app in the App Store. We're in revenue. It's a mortgage lead generator, so we're selling leads to our banking partner. But anyways, I appreciate the time. Appreciate you having me, Scott, and you're highly respected in the industry, and love your content, man.
My pleasure. Thank you. Yeah, it took us too long to do it, but here we are. Thanks. We'll have to update it. When the Series A comes in and you're originating millions of mortgages.
I hope so.
We will. Thank you.
Thanks, Scott.